We should. We're live.
Good morning. I'm Ryan Klumpner, Chair of the San Diego Housing Commission Investment Committee. The time is 8:08 on July 10th, 2020. I'm calling to order this meeting of the Investment Committee. The process we're using for today's meeting is authorized by Governor Gavin Newsom's Executive Order N29-20, which he issued on March 17th to address the COVID-19 public health emergency. The meeting is occurring by video conference with all board members and staff participating by video. For the record, I will ask board members to indicate their presence. Commissioner Hubbard is not with us yet, but will be joining us shortly. And I am here, obviously. No members of the public are in attendance. However, members of the public may watch the video conference and hear the audio of today's meeting, which is being streamed live online. The agenda for today's meeting included a link to the website for the San Diego Housing Commission Board of Commissioners, where the public can access the live streaming of today's meeting. The public has been provided an alternative opportunity to provide comments to the board through an online comment form. A link to this form was also included on the agenda for today's meeting, which was posted at the San Diego Housing Commission's website, SDHC.org, on Wednesday, July 1st, 2020. A revised agenda was posted on the Housing Commission's website later the same day. That's a different meeting, never mind. The agenda and the public comment form explained that comments about items on the agenda will be read into the record if they were submitted by 4 p.m. yesterday, Thursday, July 9th. In addition, non-agenda public comments were submitted by 8 o'clock this morning will be read into the record. There are no non-agenda public comments. No commissioners have any comments, and so we will move on to the agenda. The items we have today are approval of the meeting minutes. We will take that up shortly when we have Commissioner Hubbard with us, and I will turn it over to staff.
Great, thank you. First, we're going to do this out of order. First, we'll have the market conditions with our investment advisor, Joe Foy. So we'll do that, and then we'll go over our Q3 results.
Good morning, and thanks for everyone for zooming in. And yeah, and so as customary, we will start out with examining our core portfolio along with the current investment environment. So when we do invest, what we like to do is present when we do invest the core portfolio and look at the detail of what we are investing in. And we'll start with that we are in compliance with HUD's PIH 96-33, along with the San Diego's internal investment policy, which is modeled after the California Code to safeguard against loss of public funds. The investment objective of the portfolio is, of course, to support the mission of San Diego Housing Commission. We do this by having safety of principle, ensuring we have adequate liquidity for operational needs, a very important point. And finally, try to invest and establish the greatest amount of yield, but safety of principle and liquidity are always front first. Our portfolio is conservative by nature based on our policy. We have well-defined market sectors and maturity limits. We are not a total return portfolio, but rather managing cash flows to support operations for the San Diego mission statement. So with that in mind, I thought we would just move forward, and with the handout, as I always do, I have, if you want to turn to the San Diego Housing Commission Portfolio Summary, and it will show that as of for Q3 for year 2020, 3/31/2020, our market value of our core holdings only was $99,909,000 and change. Keep in mind, this number will differ slightly from the report that Tracy will give, and this is truly just due from a little bit different pricing matrices from San Diego's safekeeping at US Bank, whereas our pricing matrices, my pricing matrices comes from Bloomberg Bond Edge. So it's an insignificant number, but it is a little bit different. So if you catch that, that's why. It's just a pricing aspect of how they model up the different bonds that we have. So you'll see again, so we're at 99,909,000. We are up slightly from the year end, 12/31/19 year end, and it's pretty consistent for the years going back around where we're at. Annual income is about $3.1 million. That can vary depending on new investments that we have and the coupons we buy. You can also see that we have the same average coupon of purchases from the previous 12/31 and down slightly from December of 18 and 17. And this is strictly due to purchasing bonds that have a lower interest rate, lower coupon, I should say. As we move forward into different interest rate scenarios, the coupons have been dropping. However, our portfolio yield, our book yield, as you can see, is pretty much held steady at 2.32% from the 12/31, which was 2.34, and an increase from the previous years. I think with Tracy, Maria, and I, we're proud of that number. We're holding on to our book value, and a part of that is, there are other public sector accounts that will buy callable debentures, which simply is an agency bond that allows a call feature where the issuer can take the bond away. And well, why would you do that? Because they give you a little higher coupon, but they can take it away. The investments we invest in has a lot more what they call call protection. And so we're able to retain a higher book yield than a lot of other public sector accounts. So we've done a good job with that. Duration has dropped a little bit, 1.81. It's been a little stubborn for us. The goal was 2.0. However, we've seen obviously increasing demand of accounts, end users wanting duration. Duration for public sector accounts is typically 3 to 5 years and in, unlike a total return account, which could be a lot longer. So we're at 1.81, which it's adequate. We're still trying to push to get that number a little bit higher for some more call protection for us. If you want to turn to the next page, the distribution page. And in this graph, we always kind of breaks down where our numbers are as for maturity and duration. You can see the bulk of our investments are 3 years and in. We have a little tail going out a little further, but primarily 3 years and in. I also like to show duration broken down. And truly, so duration, we've mentioned this before in the meetings. Duration truly is just a gauge of what's your price sensitivity of the portfolio. And so obviously the smaller the number, the less sensitive to pricing the portfolio is. Not as important for us because we're 3 years, 5 years and in anyways, but for larger, 30-year accounts, it does draw a little more interest. But I always include it because with any portfolio, when people are examining it, one of the first questions they ask is, oh, what's your duration? And so so we have a duration number that if anybody were to ask you, you can say, hey, yeah, we're at 1.8, 1.9. So it adds some meaning to others that might examine it. As you can see, our FDICs have been rolling off. We have not purchased one in quite a while. They just haven't been as competitive versus the investments we have been buying. So we have not made a purchase of FDIC for quite some time. Let's see here. If you want to go to the next page, move along. How are we on time? 8:17. So I always list the holdings report, and it's a nice view of all the securities we own. And you got the columns of having the par, CUSIP identification, issuer name, ratings, coupon, maturity. I do have a call date, call type, even though we don't have that type of security. I leave the columns in: market price, market value, percent per market value, and effective duration. But what this demonstrates is how we use the laddering approach to investments. And if you go down the middle column of maturity, you can see that we have pretty close to every month of every year of 4 years out of an investment that comes rolling off, that's maturing. And again, the purpose of this is to add liquidity to the portfolio where we're always having monthly monies coming in case there is an unexpected operational need. We know we have monies coming in, and I'm able to give Tracy and Maria heads up prior to the 25th when payments come in of what kind of monies she can expect so she can plan better. It really helps to have the laddering effect. So you can see if you go through the pages that we filled in, and so also when whenever there's a bid wanted list or an offering out there of say 2 or 3 or 5 bonds, obviously we look at the structure of the bond and what type of yield we might expect to bid or perhaps obtain. But we also look at, do we have a hole that we could fill in our maturity ladder? So it does assist us in maintaining a constant flow of cash per month. So you can flip through and you see that there's 4 pages. We have been trying to buy larger font sizes to reduce some line items. Since we now have the hard work's done, we have a ladder. But again, there's been high demand of these bonds the last 2 months with everything that's been going on. So we just try to find bonds that best fit our needs. If you go to, we're going into our discussion of current economic conditions. And I thought for this meeting that I would focus on the Fed with everything that's happened with the pandemic and what the Fed has been doing to keep the market, monetary policy, keep everything stable. It's been very important. We just recently, 2007, 2008, 2009, what happened when they were a little bit late to the party of trying to keep the market in order. And so I thought a good demonstration of this would be, okay, so at our last meeting on that first page, you'll see we have a Fed Fund futures model. And the top of that graph is back in our meeting back on November 15th. And at that time, you could see our target rate was 1.75. Fed funds was actually trading at around 155. And the thought process, and if you remember, we're thinking that at that meeting, that the Feds would probably slow down in their easing cycle going into 2020. Little did we know what was going to happen, in February and March. So if you look at the bottom graph, you can see where we're currently at as of, well, I printed this on the 3rd of July. The target rate is 0.25, and our effective rate is 0.09 is where they're actually trading at. And what's significant here is, if you look down the implied rate of that graph on 6/16 of 21, the Fed Fund futures are actually trading at a negative rate. And there has been discussion about going negative rates for a few months now. There are countries in the rest of the world that have been trading for years at negative rates. If you turn to the next page, I printed up a screen of the world bond markets. And you can see it's listed by country and then going across the different 2-year, 3-year, 5-year, 10-year, 30-year. You can see here in the US at the time of this printing, the 2-year was trading at 0.15. However, if you go down the list, you can see Germany's at negative 0.7, Japan negative 0.14, the UK negative 0.08, and so on and so forth. So there are other countries in the world that have gone to negative rates. However, we have not. And luckily, for us, Chairperson Powell has stated that it just doesn't seem to be a good fit for us. If you turn to the next page, I decided to cut and paste a few quotes that Mr. Powell, Chairman Powell, has stated to in public, and in particular, the last paragraph, he says, "There's no clear finding that does support economic activity on net, and introduces distortions into financial systems, which I think offset that. There's plenty of people who think negative rates are a good policy, but we really don't think so at the Federal Reserve." So that really put some comfort in the markets that we weren't going to do negative rates, at least in this wasn't part of his tools of monetary policy. What are in his tools, if you want to flip to the next page, this is from the most recent Fed meeting. Continue to keep Fed fund target rates from 0 to 0.25 and increase their purchases, QE. You remember we had the QE back in 2007, 8, 9, of Treasury holdings, MBS holdings, CMBS holdings. Again, that adds liquidity to the markets. When you know bonds will trade in the marketplace, you're not going to have issues of markets freezing up. And also with those principal payments, since they own these securities, to continue to reinvest those securities. If you look at the page, in addition to, and there's some other emergency lending facilities they've created. Remember the theme of this, of the Fed, what they're doing, and they're really going all out to combat a serious lockup of the markets. And so the three that really stick out for me, being in the business I'm in, was the first two is the corporate credit market facilities. And that's important because we witnessed from 2000, 2008, if corporate bonds are not going to trade, or if they're going to trade to where spreads widen out tremendously, then what happens is your CDSs, your credit default swaps, also widen out. And it makes it difficult for companies to get their short-term funding to pay debt. It makes it extremely expensive. And that was one of the problems with Lehman Brothers, was they couldn't find short-term funding. And so in this aspect, the Fed has come in and said, okay, we are going to support if you, XYZ company, wants to bring a new issue to raise cash. As long as you're within 5 years and in, we will support that when you come to market. So in other words, if there are not enough buyers and you're having to widen your spreads to attract buyers, we, the Fed, will come in and purchase. We will come in and purchase your bonds to help with your liquidity. Same with the secondary market. They will buy bonds in the secondary market to ensure that these spreads don't widen out at astronomical levels. I think is very important. The Fed has done that. And the other item that always that is new is the municipality liquidity facility. With our COVID-19, there's been a lot of pressure on the budgets for the states and counties and cities. So if those particular entities are looking to raise cash and they need to come to market, then if they're finding that their spreads, their prices, their yields they have to offer are rising to a point where it's be hard to fund, the Federal Reserve will come in and buy those bonds to help them with their funding needs. Pretty extraordinary, I really think so. The following page. So I saw this graph. I thought I would share. I don't have time to get into the detail, but it's legislation that's been enacted to combat the coronavirus pandemic. So as you can see, 2.4 trillion. And so this is a good overview of all the different programs. And again, I didn't print up the detail, but we certainly can, in our free time, if you had interest, you can, Google some of this and look at the detail on it. But it really is an eye opener. You hear about it, but when you visually see it, it's pretty amazing. At the 2.4 trillion that they've pumped in, and I'm sure there's more programs soon to come, since obviously we're all up on current events of the new waves that have been coming in. So if you want to flip to the next page, I'll be doing on time. So just again, I always show the graph of the federal funds target rate, just perspective again, and you can see that through 16 we were raising rates, things were looking better, so we thought we'd slow the economy down slightly, and then we had the pause, and then we started lowering rates in 19, and that one last step at our last meeting, they had lowered rates, and then you can see what had happened. The drastic 150 basis point cut over those a month and a half of pretty significant. And the bottom graph is just showing a little history going back of the different nuances of the Federal Reserve. So it's not the first time that, they've tightened and then kind of overstepped, or something globally has happened and they had to lower. You can see the 3 different instances. Prior to 9/11, we were already running into a recession, and then 9/11 hit, and you can see how they eased greatly from Fed funds were at 6.5% all the way down to 1%, and then we had the move of tightening back up with the housing market boom and then bust thereafter, and then that long period from 08 to 2015 where we're basically at 0.2%, 2.5%. Next page. So I always show the 2-year because it's typically a leading indicator of what the markets think rates are going. As you can see, over the last 5 years, you could put it right on top of the Fed funds where we're at. We almost got to 3% there in 18, and now we're down to 0.16, 1.5, and then below, a 20-year snapshot of what 2s have done over the last 20 years. A lot of peaks and valleys there. Next page, I always show the 10-year, and we don't buy the 10-year, but that's mortgage rates, right? So kind of the same graph, a little bit less volatility, but you can see again the downtrend the last 20 years, and continued low mortgage rates. So all that said, with the Fed prompting and keeping up the markets, trying to assure risk assets that they're doing everything they can to add confidence to the markets. If you look at the page, I put a snapshot of the world bond markets. If you go to the bottom half, it's pretty amazing how that's the last 3 months, how the risk assets, equities have bounced back, and everybody's in green numbers, everybody's positive. And again, a lot of that's an assurance from the Fed that they're all in, and not just the U.S. but globally, of supporting the markets. Because if you look at the year to date on the top graph, you can see everything is still down with the exception of the new household name of NASDAQ, all the tech stocks, which is not a surprise, right? Not a surprise at all. We had quite a significant drop, from an all-time high, I think it was Feb 19 to March 23rd. It was I believe a 35% drop, which is historic. We've never gone from an all-time high to a bear market in that short time frame. But you can see that with some confidence, we have bounced back nicely. Next page. Some econ data I thought was interesting and tragic. Top half is non-farm payrolls. You can see, we were adding jobs for many years, and then on 3/31 we had a negative 1.3 million unemployed, and then on 4/30, 20.7 million. I thought a table looked more significant than it would on a chart. And for reference, in 2008, the biggest drop was a negative 800. So that kind of puts in perspective, negative, 20.7 million. For a year and a half, from 2008 through October 2009, the U.S. printed negative non-farm payroll numbers before we finally had a positive number. So that was 18 months of straight negative numbers. And if you look on the below graph, you can see our unemployment rate, again, is we were holding steady at 3.8, 4.0, and obviously we have skyrocketed back up. We've come back a little bit the last couple of months. Again, for reference, in 2007, the crisis beginning in April 2008, we're at 5%. We got as high as 10% in October 2009 before we started heading back down on the unemployment rate. Next page, initial claims. We have a weekly initial claims of people filing for first-time unemployment. And even the top graph, even at the height of the tragic events of 2008 and 9, we never got to 1 million first-time filers. And as you can see from the graph, and then I printed the table below, we got as high as what, 6.8 million, and that's weekly. So I thought this was a striking graph of what has happened. We are beginning to track lower, but we're still above the million mark. I did not print last week's, but you get the idea where we're at. Next page is GDP. So we printed a -5 for the first quarter final. And so we'll get news at the end of this month for quarter 2. Estimates, there was a survey of 71 economists recently. I think they surveyed them from July 2nd through the 8th. And the numbers range, the averages, you can expect a -32% on GDP for Q2 2020. Though they did survey thinking that Q3 would bounce back. You know, everybody's hoping for that V-shape or U-shape bounce back at 18%. So for the year of 2020, they're looking at a -5.5. But as we all know, those numbers can vary greatly, and they are just projections. But again, that you know, -32% is wow. Next page is I just put this in here because I think you all know I've always had the discussion about. So one of the Fed's mandates is inflation, and they use PCE core, and their mandate's always been 2%, which, you know, in the world we live in, a lot of us, I'm in the camp that feels that perhaps they should adjust that number lower. So we were approaching 2%, as you can see with the graph, but now with, you know, unforeseen events, we're down now to about 1%. And again, inflation is really not an issue at this point, but I just thought I'd show the graph to stay consistent with all my other reports of where we're at with PCE core. And then finally on the last page, just the Fed projections, they have come out quarterly. And I think you can see what's interesting is when you look on the left-hand column, change in real GDP, you know, they're projecting for the year at -6.5, whereas back in December, their projection was 2.0. You know, employment rates, et cetera, as you go down the list. It's a nice reference to look at where the Feds think we're going and where they thought we were going. So that concludes our kind of our market view. How does that all affect our investment portfolio? It doesn't affect any of the safety of principal or liquidity, but what it will do, our book yield will begin to slowly go lower, but will always be higher than the pools or the our standing cash. We don't try to call the market, but rather just layer in, you know, payments that we need to invest, and kind of a cost averaging in. So really, that's the only effect is we could probably expect a little bit lower book yield in the coming year. Any questions?
No, that was great.
Sorry, a little lengthy. Apologies. It's hard to try to get everything in, and
well, thank you.
in a short amount of time.
We knew that.
Going on in the world. Thank you. Yeah.
Thank you.
I just have I'll quickly go over it. This is actually an informational item for the board meeting today. If we could turn to page 2, portfolio summary by investment type. I'll just do a quick overview. Our overall market value of our investment portfolio increased to $174.57 million compared to our previous quarter of $159.9 million. And this $15.28 million increase is primarily due to a receipt of $17 million from the sale of Mariners Village. And also we had a payoff from Mission Terrace, loan payoff, but that was offset. We paid a couple loans to developers for J Street to extend affordability, and also a couple other milestone loans for affordable housing development. So let's see, our Our yield is still at 1.81%. I think Joe talked about that compared to 2.04 from previous quarter. Our effective duration has decreased a little bit from previous quarter. Our portfolio yield is decreasing because of the Fed Reserve has lowered its basis points 50 in March 3rd and another 100 on March 15th. And we continue to, invest our monies in a very conservative manner. Everything is liquid, conservative, and we have the laddering approach so that we have monies when we need them for unexpected operational needs. So that's basically it. Nothing too exciting about that.
Great.
We're safe and we're liquid.
We're safe and we're liquid.
Yeah. And keep in mind, those numbers she read off, that's the total portfolio. So I just showed the core amount.
Yeah.
This includes our short-term investments or liquid investments.
Yeah. Because we also have money with LAIF, the county, the account and the San Diego County investment pool. And we have our unrestricted cash as well. So.
Great. I don't have any questions. I think you guys covered it very much. Obviously, crazy times that we are in, and I think you addressed sort of all of the issues happening. Certainly, as much as I would be able to dig into on those economic issues. So I appreciate that. And yeah, I mean, all things considered, we're exactly where we need to be, looks like. If let's see, we still don't have Commissioner Hubbard, so I think we might have to adjourn and then chat with council about how to do minute approval at another time. I'm thinking, unless somebody has another idea.
Scott? Thank you.
I think that's the best course of action.
Okay. Well, then with that said, we are adjourned at 8:40 a.m. and thank you all very much.
Thanks, Ryan. Thanks,